If you were born in the 1940s, 1950s, or 1960s, Congress did change tax rules that may affect homeowners. But it did not create a nationwide property tax freeze based on your birth year. That distinction matters because the wrong claim can send you searching for forms that do not exist, while the real savings remain unclaimed at your state or county office. I am no licensed expert, but on this channel, every week, I cover the real financial information that affects seniors directly, the rules that changed, the protections you may already qualify for, and the steps that can make a practical difference. This is exactly the kind of content I put out every single week, and you do not want to miss it. If that is the kind of information you want to hear, make sure to hit subscribe and turn on notifications right now. Now let's get into it. Start with the most important correction. Property taxes are generally imposed and administered by state and local governments. Your county, city, township, school district, or another local taxing authority determines the taxable value, the rate, the exemptions, and the appeal process. Congress can change how state and local property taxes are treated on your federal income tax return. But Congress does not normally freeze your county assessment simply because you reached a certain age. So, what did Congress actually change? For 2026, the federal deduction limit for state and local taxes is $40,400 for most filers, or $20,200 if married filing separately. The limit begins to phase down at higher, modified adjusted gross income levels. But this is an itemized federal deduction. It does not reduce the bill issued by your county, it is not limited to seniors, and it helps only when itemizing produces a better result than taking the standard deduction. Congress also created an additional deduction for people aged 65 and older. For tax years 2025 through 2028, an eligible person may claim up to $6,000 or up to $12,000 for a married couple when both spouses qualify. That deduction phases out above specified income levels, and it can be available whether you itemize or take the standard deduction. Again, this is real federal tax relief, but it is not a federal property tax exemption. That leaves two separate systems. Federal law determines deductions on your federal return. State and local law determines whether your home receives a homestead exemption, senior freeze, tax ceiling, deferral, circuit breaker rebate, portability benefit, or another property tax protection. Mixing those systems together is where homeowners get confused. Now let's look at what your birth decade actually tells you. If you were born in the 1940s, you are roughly in your late 70s through mid-80s in 2026. That means you clear the age threshold for nearly every program that begins at 65, 70, or 75. But age alone may not be enough. Many programs also require the home to be your primary residence, require you to own or hold a qualifying interest in it, impose household income limits, or require a new application every year. Illinois is a useful example. Its low-income senior citizens assessment, freeze homestead exemption, begins at age 65, has an income limit, and requires an annual application. The word freeze can also be misunderstood. The program can hold the home's equalized assessed value at a base level while eligibility continues, but the final tax bill may still rise if tax rates increase or taxable improvements are added. Texas uses a different system. Homeowners aged 65 or older may qualify for an additional residence homestead exemption, and school district taxes can be subject to a ceiling. That does not mean every line on the property tax bill is permanently frozen. Cities, counties, and other taxing units may follow different rules, and the homeowner generally must make sure the correct exemption is on file. New York is different again. Enhanced STAR provides increased school property tax relief for eligible homeowners aged 65 or older who meet income and residence requirements. Beginning in 2026, the state simplified the transition for some homeowners reaching 65 But that is a New York change, not a nationwide federal rule. For someone born in the 1940s, the best question is not, where is the new federal senior freeze form? The better question is, which age-based programs does my state or county currently offer, and have I completed every application and renewal? Ask specifically about a senior homestead exemption, assessment freeze, school tax relief, tax deferral, circuit breaker, and any program for veterans, surviving spouses, or people with disabilities. Also, ask whether relief can be applied retroactively. Some jurisdictions allow a late application or correction for a limited period. Others do not. If your exemption disappeared after a refinance, a deed change, the death of a spouse, or moving the home into a trust, request a written explanation. A change in ownership records can interrupt benefits even when you still meet the age requirement. Homeowners born in the 1950s are now generally in their late 60s through mid-70s. By the end of 2026, everyone in this decade is at least 67, so this entire group clears the common age 65 threshold. The difference is that many people in this group recently retired, changed income sources, paid off a mortgage, or started receiving Social Security. Those changes can affect income-tested property tax programs even when the value of the home has not changed. This group should pay close attention to the new federal senior deduction. If you are 65 or older and your income falls within the phase-out rules, the deduction may lower federal taxable income. It does not matter whether you own a home, but homeowners may overlook it because they are focused only on property taxes. At the same time, compare your allowable itemized deductions, including qualifying state and local property taxes, with your standard deduction. Do not assume that the higher SALT cap automatically means itemizing is better. There is another correction that matters for longtime homeowners considering a sale. Federal law may allow you to exclude up to $250,000 of gain from the sale of a main home, or up to $500,000 on many joint returns if the ownership and use tests are met. There is no general extra $100,000 home sale exclusion simply because the seller is between 66 and 75. Your adjusted basis, documented improvements, periods of rental or business use, and prior home sale exclusions can materially change the calculation. Before selling, locate the original closing statement, records of major capital improvements, and documents showing how title is held. A new roof, an addition, a major kitchen renovation, or certain accessibility improvements may increase basis and reduce taxable gain. Ordinary repairs usually do not receive the same treatment. The correct paperwork may be worth more than any viral senior supplement that does not exist. So here's what I want you to do. The benefits, the discounts, the assistance programs most seniors qualify for but never actually use, I gathered them all in one spot, organized by state and by program, so you don't have to dig through confusing government websites for hours. It's quick, it's straightforward, and any senior can find exactly what fits their situation. No matter what state you're in, there's help out there you're probably leaving on the table. It's called the Senior Exemption Playbook, and it's sitting in the first pinned comment right under this video. Just tap it once and you'll have everything you need. Now stay right here, because the last one is the filing trap that can wipe out a valid senior exemption even after you qualify. The deadline and renewal rule your county may never remind you about. Now, homeowners born in the 1960s need to divide into two groups. People born early in the decade may already be 65 or may turn 65 during 2026. People born later in the decade are still below the most common senior threshold. That does not mean there is no relief. It means you must search by more than age. California is the clearest example. Proposition 19 allows eligible homeowners age 55 or older to transfer a base year taxable value to a replacement primary residence, subject to detailed conditions and filing rules. That can be extremely valuable when downsizing or relocating, but it is a California constitutional program. It is not a $5,000 federal downsizing credit, and it does not apply automatically in every state. Someone under 65 may still qualify for a general homestead exemption, a low-income circuit breaker, disability relief, disabled veteran relief, a surviving spouse benefit, or a local tax deferral. Some programs begin at 55 or 60. Others have no age requirement at all. For this group, the mistake is waiting until 65 without checking what already exists. Be especially careful before moving. In some jurisdictions, a long-held home has a protected or limited assessed value. Selling it and buying another property can reset the taxable value, unless a portability rule applies. A smaller house can therefore produce a higher property tax bill than expected. Before closing, ask the assessor in the destination county for a written estimate and ask whether any transferred value, homestead, or senior benefit requires filing within a fixed number of months or years, and do not rely on invented federal forms. There is no IRS Form 1098, S.R. for a nationwide 3% senior assessment cap. Schedule R is used for the federal credit for the elderly or the disabled. It is not a 15% aging-in-place renovation credit. The familiar Form 1098 reports mortgage interest, and the federal home sale rules remain tied to the actual IRS ownership and use requirements. Now we come to the deadline and renewal trap. Many property tax benefits are not permanent simply because you qualified once. One county may renew an exemption automatically. Another may require an income statement every year. A third may require a new filing after a move, deed change, marriage, divorce, death, trust transfer, or change in occupancy. Missing the deadline can delay relief for an entire tax year. Here is the safest process. Pull your latest property tax bill and find the parcel number, assessed value, taxable value, exemptions, and every taxing authority listed. Then use the official state revenue, county assessor, appraisal district, or tax collector website. Search the exact term senior property tax exemption, over 65 homestead, assessment freeze, property tax deferral, and circuit breaker. Avoid websites that promise a federal senior property tax grant or demand payment for a form that your government office provides. Free. Next, call the office and ask 5 direct questions. What programs apply at my current age? Is there an income limit? Must I occupy the property on a specific date? Is the benefit automatic or application-based? Does it renew automatically or must I file again each year? Then ask for the deadline, the official form number, and the answer in writing or by email. Keep copies of proof of age, identification, deed or trust documents, occupancy records, income records when required, disability or veteran documentation when applicable, and the submission receipt. If you file online, save the confirmation page. If you mail the application, use a trackable method. If the exemption is denied, read the appeal instructions immediately, because appeal windows can be short. Also, separate an exemption problem from an assessment problem. An exemption reduces taxable value or tax under a program. An assessment appeal argues that the government's value or classification is wrong. You may need to pursue both. Compare the assessor's description of your property with reality: square footage, condition, number of rooms, land size, and comparable sales. A senior exemption will not correct a factual error in the assessment record. Let's bring this together. If you were born in the 1940s, you are old enough for most senior age thresholds, but you still need to verify income rules, annual renewals, and whether a freeze controls assessed value rather than the final bill. If you were born in the 1950s, review both sides. state or local age, 65 property tax programs, and the real federal changes, including the temporary senior deduction and the higher SALT limit when itemizing makes sense. If you were born in the 1960s, do not assume you must wait. Early decade homeowners may now cross age 65, while others may qualify through age 55, portability, disability, veteran, income-based, or general homestead programs. The headline is not that Congress ordered every county to calculate property taxes by birth decade. It did not. The real story is that Congress changed federal deductions while states and local governments continue to control the exemptions, freezes, ceilings, deferrals, and deadlines that directly change your property tax bill. Your next move is simple. Verify the federal deduction rules on your tax return, then verify the local property tax rules attached to your actual parcel. Use official forms, get confirmation, and put every renewal date on your calendar. That is how you turn your age, your income, and your home ownership status into relief that is real, not relief that exists only in a headline. Subscribe and turn on notifications, because every week I break down the financial rules that affect seniors, the paperwork behind them, and the deadlines that can cost you money when they are missed.